Welcome to UAN Governmental Fund Accounting Course 103. In this video, we're covering Budget and Cash Management in Chapter 2 of 3. Additional chapters in this series are Budget Changes and Debt and Projects. Let's begin. We'll start with Interfund Transfers. Interfund transfers are the permanent movement of cash from one fund to another. Like the picture you see here, the water flowing out of the upper bucket into the lower bucket. It isn't going to flow back up against gravity to the top bucket. It's a permanent movement. Interfund transfers always require board-adopted legislation. The interfund transfers use the unencumbered appropriations from a transfer-out appropriation account from the sending fund and is received in a transfer-in revenue account in the receiving fund. The process involves cash and both budget components. To process an interfund transfer, you need the following items. The funds must be permitted to participate. You must have the unencumbered transfer-out appropriation balance in the sending fund. If it's not there, the board will have to adopt supplemental appropriations or reallocation legislation to place the unencumbered appropriations in the transfer-out account. The board must adopt legislation authorizing the fiscal officer to process the interfund transfer. And the transfer-in revenue amount must be included on the amended certificate in the receiving fund. If it wasn't included in the revenue certified at the beginning of the year, you must request a new amended certificate. If a new amended certificate is required, the board may then adopt supplemental appropriation legislation to authorize the spending. You can see the interfund transfers must be incorporated into the operating budget. If the interfund transfer isn't planned at the beginning of the year, this isn't going to be quick or easy if you have a cash crisis. It has to be planned and all the legislation adopted. Read this section in the book for more information and examples of interfund transfers. The next item we're going to talk about is interfund advances. An interfund advance is the loan of cash from one fund to another. They are generally used to help with a cash flow shortage for a short period of time, or sometimes in a capital project fund when the money has to be spent first, then a grant reimburses you when you prove you met the grant criteria. Interfund advances always require board-adopted legislation. Remember, this is a temporary loan. The receiving fund must pay back 100% of the advance within 12 months, and if it's not paid back before the current fiscal year ends, the unpaid advance has to be included in the resources available in both funds, one negative and one positive. To process an interfund advance, you need the following items. The funds involved must be permitted by law to participate, and to participate with each other in an interfund advance. Don't forget to evaluate whether the sending fund will be able to continue operations until the loan is repaid. Don't create a cash flow problem in one fund to resolve a cash flow problem in another. There should be a plan to repay the advance. And the board must adopt legislation authorizing the fiscal officer to process the initial advance, then adopt additional legislation authorizing the repayment. Repayments can be made in increments as money flows in or all at once. Although the processing of an interfund advance uses appropriation and revenue accounts for advance in and advance out, these accounts are never budgeted. Accounts are used to post the advance to complete the annual financial report. When would an advance be useful? Well, when you have a levy-supported fund that only receives tax revenue twice a year, but bills are paid each month. Revenue estimates are accurate, and there are sufficient appropriations, but the cash is insufficient for current expenses. Cash will be received with the next tax distribution, thus allowing repayment. An advance would help with this cash shortage. When is an advance not useful? When revenue estimates are accurate, but cash and appropriations are insufficient for operations. There's no variance to make additional appropriations. This is not a cash flow problem. This fund doesn't generate enough revenue to operate. Remember that advances do not increase the resources available for appropriations. Advances only supply temporary cash. So don't consider an advance if the receiving fund cannot repay the advance. Make sure you and your governing board understand that an advance does not fix a lack of sufficient resources for appropriations. Remember that although the law allows an advance to be paid within 12 months, it is far easier to pay them back by the end of the current fiscal year. If any unpaid balance is carried over to the new year, it becomes an adjustment to the carryover cash balance certified to the county auditor at the beginning of each year. Remember that certificate of the total amount from all sources available for expenditures and balances? Unpaid advances are one of those adjusting items to the cash balance. Keep your governing board informed about all unpaid advances and be prepared to advise how much can be paid back at each meeting until they're paid in full. Unpaid advances do not go away. They must be repaid. Read this section in the book for more information and examples of interfund advances. Now let's switch gears again and talk about monitoring the budget. The fiscal officer must continually monitor both components of the budget and the unspent balance on purchase orders. A quick review of reports after bills are paid, after payroll, and at the end of the month will help you stay ahead of budget shortages. You should always keep the governing board and department heads informed when budget shortages are just beginning to show. You must understand your legal level of control so you know what you can reallocate and when the board is required to adopt legislation. Let's start with monitoring our revenue budgets. You should monitor the revenue budget by fund and individual revenue accounts, comparing estimated revenue, your revenue budgets, to actual receipts. UAN reports that are helpful in this process are the revenue status, which lists each revenue account by fund and compares the revenue budget to actual receipts, shows the budget balance, the percent received to date, and it totals all the columns by fund. It's useful to see a snapshot of individual revenue accounts and fund totals. The revenue ledger shows the original budget, each receipt posted against the revenue budget, and the remaining budget balance. The revenue ledger is useful to review the individual receipt postings to verify they were posted to the correct account. Posting errors will cause incorrect budget balances, and you won't see mistakes if you're only reviewing the revenue status. You must understand the revenue flow of each revenue account in order for the revenue status percent received column to be meaningful. Look at each revenue account, understand what is posted to the account, and understand how often you receive the revenue to determine if it's on track. We'll cover this more in depth in just a minute. You should also evaluate the fund's total revenue budgets compared to the total revenue received. The revenue status is good for this. So you don't just look at each fund's individual accounts, but you also pull back and look at the fund as a whole, especially when a fund like the general fund receives various sources of revenue at different times of the year. I want you to understand how each revenue account has its own revenue flow. Money comes in at different paces. We're looking at a sample of a general fund that has various sources of revenue and several revenue accounts. These two accounts, for our purposes, receive postings monthly. The local government money is distributed by the county about the same time each month. In our interest example, our general fund receives a portion of interest from all investments and the checking accounts posted each month. Your interest may not all be distributed monthly. It depends on your investments. So be sure you understand which investments and accounts are posting to the interest accounts in your funds. The cable franchise fees are paid quarterly, so I have to understand I only receive distributions 4 times a year. My percent received has to be evaluated based on quarterly distributions. Property tax distributions happen twice a year. County first, followed by a much smaller state allocation. Our sample liquor and cigarette taxes are received once a year. And then these last 2 accounts are consumer driven. I have no idea when someone is going to rent the town hall for a birthday party or purchase a zoning permit. Consumer driven revenue can be tricky and must always be monitored closely. When I look at the fund's percent year-to-date received, I need to understand if the percentage indicates the overall fund is on track based on when I should have these revenues. Evaluate individual accounts as well as the fund total, and keep your board informed about cash flow for funds that have a limited source of revenue. Remember our earlier chapter on changes to the amended certificate. If you see a substantial windfall or shortfall, evaluate the fund as a whole to see if you should request an amended certificate. In this section, we'll use the term purchase order to refer to all encumbrance types, purchase orders and blanket certificates. You want to review all open purchase orders after bills are paid and at the end of each month before posting the bank reconciliation. Remember that in the UAN software, you prepare the bank reconciliation and save it when you reconcile, but you don't post the bank reconciliation until you run a check over the budget items, and one of these budget items is your open purchase orders. The encumbrance left on purchase orders that are no longer needed is locking away that balance from other uses. So review your open purchase orders and ask yourself the following questions. Will any more payments be made from this purchase order? If the answer is no, close that purchase order so the unspent balance is unlocked and returned to the unencumbered balance on each appropriation account. If the answer is yes, more payments need to be made off this purchase order, evaluate whether the unspent balance is sufficient for ongoing needs. If the unspent balance is sufficient, no action needs to be taken. But if you do need additional encumbrance for ongoing purposes, you must open a new purchase order. You can't add more encumbrance to the current purchase order. A new purchase order may require reallocations or supplemental appropriations, so make sure you're prepared to advise your governing board at the next meeting so they can adopt the necessary legislation. Once you enter changes to the appropriations, you can add your additional purchase order. Reviewing open purchase orders is a regular housekeeping chore. A frequent review of your open purchase orders, such as after bills are paid and at the end of the month, allows you and your governing board to review accurate unencumbered balances when spending decisions need to be made. The key to monitoring the appropriation budget is to always review the purchase orders before you review the appropriation budgets. Two UAN reports most helpful in the process of evaluating appropriations is the appropriation ledger to see the individual purchase orders and payments posted against the appropriation account. This review reveals posting errors on the appropriation accounts. Remember in Fund Accounting 102, I showed you my utilities appropriation ledger that had a purchase order for office supplies. When mistakes are found and corrected before month end, your financial reports will reflect accurate unencumbered balances and help the governing board make good decisions. For an overall look at the appropriation accounts, use the Appropriation Status Report. The status report lists each appropriation account by fund and allows you to see the final appropriation, your appropriation budget, the current reserve for encumbrance, which means the balance remaining on an open purchase order, your year-to-date expenditures, the current unencumbered balance of the account, the percent spent, and it totals all these columns by fund. It's useful to see a snapshot of individual appropriation accounts and fund totals, but you're not going to find posting errors just using the status. Always do a monthly check of the appropriation ledger after you've done your purchase order review. If you discover that an unencumbered appropriation balance is running low, you need to run the following checks to be prepared. Review the comparison of budget and appropriated report to see if there are any resources available that haven't been appropriated in the fund. That's your variance column. If available, the board can adopt supplemental appropriation legislation at the next meeting. The supplemental appropriation budget is entered on the fund's appropriation accounts. But if there isn't sufficient variance to make supplemental appropriations, you need to review the appropriation accounts within your legal level of control to see if there's an account that has an unencumbered balance that can be used to reallocate. If so, post the reallocation. You may want to discuss this with your department heads before taking away some of the unencumbered balance of an account they may be planning to use. If accounts within your legal level of control don't have an unencumbered balance to use, review the unencumbered balance of the appropriation accounts that are outside your legal level of control. If the unencumbered appropriations are available to reallocate, at the next meeting the board can adopt legislation authorizing the reallocation of appropriations. And after that's adopted, post the reallocation. But if no appropriation accounts in the fund have sufficient unencumbered balance to contribute to a reallocation, Consider the next option. Townships often have more than one fund that supports road operations. So if one of your road funds is short, you can start spending from one of the other road funds permitted for the same purpose. It may require the addition of account codes and budget reallocation to take place for these new items. Now, villages, libraries, and special districts would have a more limited ability to use multiple funds for the same purpose. Be careful, don't spend restricted money improperly. You may not have a second fund that can contribute. And make sure you're prepared at your next meeting when legislation is required for any reallocations or supplemental appropriations. Stay ahead of these issues. You should never be surprised when you run out of appropriations. Your board shouldn't be surprised either. So when there is no supplemental appropriation to be made, when no reallocations can be made, the governing board is going to have to slow down spending. Now we're going to switch gears again and talk about monitoring the fund cash balances. We've been talking about monitoring the budget, but we know that the budget components do not magically place money in your bank account, like this genie. Cash balances fluctuate with receipts and expenditures. Review your cash balances before and after paying bills and posting payroll, and of course again at the end of each month, to be able to advise your board if current balances and cash flow will support the ongoing expenditures. Available appropriations and purchase orders do not represent the availability of cash to pay the bills. Our components of the budget tell us the plan for each fund. For example, the amended certificate shows how much we plan to have during the year. In this sample, it shows we have $29,235 of cash available at the beginning of the year, and we expect to receive $54,000, giving us a total annual resources available of $83,235. In addition, our governing board has appropriated $80,000, leaving us a small variance of $3,235 not appropriated. Now, pay attention, this is not cash. These are the budget components. They don't tell you about cash. Let's just drop those out of there and look at how cash is coming into a fund. There really isn't one UAN report that's going to show you your cash flow like this one each month. I created this for training purposes. I needed you to see the big picture, so I created a chart. What you can see in the chart is this fund receives $4,500 each month. That helps me to see how the cash flow comes into the fund. Let's make this a little more complex by adding expenditures. Here's the same fund with monthly expenditures added. The monthly fixed costs are approximately $1,400 per month. You can see that the fund balance steadily increases until we have a $36,400 in expenses in July, a regular $1,400 fixed cost plus $35,000. This could be a paving project for a township or village, the purchase of furniture or remodeling for a library, or a fire and EMS department new piece of equipment. The point is, we had to plan the $35,000 expenditure around our cash flow so we have money to pay the bill and we don't reduce the cash balance of the fund too low for operations. When viewing the cash flow like this, we see that we actually had the $35,000 available by February. But if we spent it then, our fund balance would have been very low, leading to a possible cash crisis if we had to make repairs that weren't expected. Let's step up the example with some fluctuating numbers so it's a little more realistic. Here we have a fund that starts the year with a nice $72,127 carryover balance. The fund receives semi-annual tax distributions in March and August, but no other income. Notice how the expenses fluctuate each month. That's more realistic. Even the electric bill will fluctuate month to month, changing our total expenditures. Notice in June and December we have expenses in the amount of $52,800. So let's imagine this fund has to pay a debt payment twice a year. Before we entered into the debt, we should have reviewed our cash flow and the semi-annual repayment schedule to see if the fund could support the loan repayment. This fund is in good shape right now as far as cash flow, But notice the year began with $72,127 and it's ending with $64,647. Now, if we continue at this rate for too many years, we'll be in trouble. When you consider taking on a loan or a large capital outlay, you really need to know how it's going to affect the carryover balance and continued operations in the next year. If this fund will have the loan paid off next year, it's not going to be a problem. But if the debt payments go on another 10 years, we're going to have to find some more revenue to keep the fund operating. See how you have to watch what happens to the cash monthly and year to year when considering debt and capital outlay. This was a nice, healthy fund. Let's take a look at a fund that wasn't so well managed. Yep, this fiscal officer is caught in a cash flow trap. The governing board ought to be trapped with him. This unhealthy fund took on too much debt, and the loan payments have reduced their carryover balance each year. Notice that the fund began this year with $8,000 and the January bills were $7,800, leaving only $200 to operate until the first half taxes were received in March, probably after the bills need to be paid. This fund is going to have a cash flow problem, and it's a crisis. The governing board should have a plan in place to get this fund through the rough months. However, even if you consider an advance to get you through March when the tax settlement arrives, paying back the advance is going to be difficult. You would have to receive every penny of estimated revenue and reduce spending to the absolute essentials for this fund to make it to the end of the year and pay back in advance. Even worse, the fund ends the year with only $520, making it impossible for this fund to continue operations the next year. An advance would only be a band-aid on a true need for more revenue. The board should have seen this coming 2 years ago and got a newer replacement levy on the ballot for the voters to approve. Now, sometimes you just can't get the levy passed by the voters, and you have to consider cutting back service or transferring cash permanently on an annual basis to support operations. Once this debt is paid in full, this fund could recover, well, at least until the next piece of equipment needs to be purchased. The fiscal officer and governing board need to evaluate each fund on a regular basis to really understand the amount of debt or capital outlay the fund can support without a change in the revenue. Our last sample is a cemetery fund that is supported only by consumer fees. Consumer-driven revenue can be tricky to estimate, and since many of our clients have cemetery funds supported by consumer revenue, I wanted to show an example. In the cemetery fund, you can see that we've estimated the graves sold and the fees collected based on an average in the past several years, but this is tricky. You really don't know how much you're going to receive. It's your best guess on past history averages. However, the operation expenses can be estimated closely based on prior year cost of operations. A cemetery has less expenses in the winter when the mowing starts, the employees and the fuel costs increase, and then they decrease again as the mowing stops and the cold weather's back. The spending pattern of the fund can pretty well be planned, but you can't make the consumer buy. It's very much need-based. But the government still needs to be able to pay for operations even when the revenue doesn't come in as planned. The governing board should be reviewing, discussing, and getting a plan ready as the months progress so there isn't a cash crisis. So take a look at the chart. Our problem is we've sold no graves and collected only a few fees this year. By June, the governing board should be recognizing a problem may arise and start formulating some plans. Would an advance be a good idea? Or should the board consider a permanent transfer? Well, think about what you've learned earlier in this chapter. An advance might be a good idea if we actually start receiving the anticipated revenue, but if we don't meet the revenue expectations, we won't be able to operate or pay back the advance. So an advance is only going to work if we really think the revenue will roll in this year, and it does. Advances should only be considered if they can be paid back. So if an advance was made, and as the year approaches and revenue doesn't come in, the board would need to consider making a permanent transfer not only to keep operations going, but to repay the advance. Advances must be repaid. So if the advance is their first plan of action and the revenue doesn't come in, the permanent transfer should be legislated, then the advance repaid. It would be something your governing board would want to monitor closely each month and make that final decision in December before year end. The section in the book has several different examples, some samples of when an interfund transfer has to replace the initially planned revenues certified on the amended certificate. Read this chapter in the book for a more in-depth study of cash flow. In this chapter, you learned about interfund transfers, the permanent movement of cash between funds. It's a budgeted item. We learned about interfund advances, the temporary loan of cash between funds that must be paid back. It's not a budgeted item. We talked about monitoring the budget for revenue budget balances, purchase orders unspent balance, and the unencumbered appropriation balance. We also talked about monitoring the cash flow and keeping your governing board informed. This concludes UAN Governmental Fund Accounting 103, Chapter 2.